I'd like to welcome our new sponsor, Rothschild Capital Solutions. Rothschild is a commercial investment banker and direct lender. The company targets well-located assets for value-add investment primarily in the Midwest and the Southeast. Rothschild is positioned to invest up to $35 million per deal. They may be just the partner or lender you've been looking for to turn your deals, even the most aspiring, into reality. Need capitalization beyond a debt financing loan? Rothschild gives you a full set of options: JV equity, bridge, preferred equity, mezzanine, development and construction. What do you need? The chances are Rothschild can provide it, as well as the experts to make the deal real. Click on the banner below the show to contact Gary Williams now. You've got the deal, Gary's got the backing you need. Click now. Hello and welcome back to another exciting edition of Money Talks. I'm your host, Michael Thomas, here to speak with Winston Crowley today. Winston is a vice president and investment officer at UMB Bank. If you recall, a while ago, I had an episode where I said I am going to bring somebody on to explain in layman's terms negative interest rates. I've got Winston here to do that today. UMB is a very strong regional bank. It was founded in 1907 in Kansas City, Missouri. Today, they have about $29 billion in assets. And Winston, we're so glad to have you here. Thanks for being on the show.
Thank you very much for having me. It's a pleasure to be here.
So the 10-year Treasury yield is trading today around 83 or 84 basis points. Obviously upticked a little, about 10 bips in the last week. What are you seeing now as a trend? And, what do you kind of see going forward kind of to the end of this year, maybe going into next year? I mean, I heard one analyst say, the coronavirus vaccine could, we could be, up over 1%, 5 minutes after that's announced. I mean, nobody really knows, but what are your thoughts on the 10-year yield?
So we've seen things back up a fair amount in the past week and a half. And I think it's really reacting to, additional government stimulus that seems to be getting closer and potentially pricing in some inflation on the back of that. The government's going to be borrowing a lot. So if you're actually funding these stimulus plans, then there also will be additional borrowing. That's just additional supply that's potentially weighing on the market. I don't expect to see a massive breakout to the high side. I think the Fed is pretty focused on keeping the curve flat and rates low for not just the long end, but the short end as well. So I do think that I don't expect to see a massive breakout towards the end of the year, the 10-year.
Mm-hmm. Got it. And as far as the keeping that, yield down, I mean, how much of a factor do you think the Treasury basically buying our own security instruments, is that a big contributing factor to keeping that low?
Absolutely. The Fed uses open market operations pretty extensively. And if you just look at what's going on in the corporate bond market and where yields are there for bonds with credit risk, right, versus just, risk-free instruments like treasuries, the Fed has been quite active in really pushing down long-term yields for borrowers, the U.S. government included. And the U.S. government is a massive borrower at the moment and really needs rates to be low.
Right. That makes sense. Yeah, I read an article that said the BBB bonds, I think a lot of the ones related to, office and sort of the big properties in places like New York, we're trading at something like 20 points over the U.S. Treasuries.
Spreads for BBBs are really something to watch right now, especially for industries that are a bit more affected by the coronavirus. There's a lot of talk around a fallen angel and what that looks like if it goes into the high yield space. Because once you get downgraded, as you know, out of BBB to BB, you're suddenly high yield and no longer investment grade. And that dramatically changes your potential investor mix.
Right. And it makes sense that you'd have to, obviously price that accordingly, right? Price it for risk.
Well, and you would think that the market, in normal times, the market does price things for risk quite a bit more for the potential of a fallen angel. Right now, I don't think that some BBB spreads really reflect the potential that these bonds drop out of the investment grade universe. Now, there are certain industries or sectors that are less vulnerable to that. I would point to some of the BBB bank names, for example, that I don't think are at significant risk of being downgraded into the high yield market. given what that would do to their ability to raise funds and their cost of capital. I don't see that as very likely for names like Citigroup and Bank of America that are massive, too big to fail institutions.
Sure. Yeah, of course. That makes sense. Kind of in a league of their own in that sense. But speaking of risk, and let me jump into the question I've been dying to ask a professional like yourself, which is the negative interest rate discussion. Now, we haven't really had a lot of that talk recently. It was, months and months ago, that was more of a discussion point. But there still are countries that have negative yields on their bonds, Germany and France in particular, and trying to understand from a layperson's perspective, how does a negative yield, in other words, investors are typically buying bonds and they're receiving a payment. How does a negative yield actually work or make financial sense?
Well, and so for investors that have an option to get away from negative yields, it typically does not make sense. You hit the nail on the head. Nobody wants to buy a bond that's going to give you less money back at the end of the term. Now, that said, negative rates are not 3%, negative 4%, negative 5%. We're looking at, negative 0.5%. And if you think about it from a real interest rate perspective, a real yield, and we already have negative interest rates in the US from a real yield perspective. It's less jarring because you're getting 0.5% and inflation's eating 2.5%. So your real yield is a negative 2. But that said, going back to your original question of how or who really wants to buy these bonds, it's not a question of whether or not they want to. It's really a question of what their alternatives are. And if you think about a government entity or a pension manager that has investment policy requirements to have a significant percentage of their bonds in government guaranteed assets that are, for example, in the Eurozone or something like that, they just may not have the alternative to go buy a bunch of US government bonds that are positive yielding or another asset outside of their typical investment mix. So there are a fair amount of forced buyers for these type of assets.
And they must have a lot of capital that they just need to deploy. It wouldn't be individual wealthy folks. You're talking about sovereign governments or institutions. Is that generally who?
Yes, major institutional buyers. You don't see a lot of individual retail folks going out to try and secure, negative yielding assets or having that make sense for their portfolios. It's large institutional clients that have, lots of dollars to put to work, or lots of euros in this case, and don't really have a choice of, can't put it anywhere they want to.
I see. Okay, that makes sense. Sort of an asset of last resort, I guess.
It's often the least bad option for some of these folks, and you see it, and you have negative corporate bond yields in certain cases too. But corporate bonds sometimes will yield, very slightly positive. But at the same time, you can't, if you're a government, for example, and you have excess funds that are in a capital reserve of some kind, you can't put that responsibly, or in your investment policy probably won't let you put that into 100% corporate bonds or 100% equities. You need to be buying safe, riskless assets, and those riskless assets now have a negative yield.
Makes sense. That makes sense. I feel like I'm starting to understand this. That's good. So going on that topic, let's just say hypothetically, I guess you said the real yield is negative if you're talking about inflation, which is like the Treasury inflation protected securities you're referring to. Mm-hmm. But let's just say the yields did go negative, just the yield on the 10-year. Since as a mortgage lender, we track that 10-year, and a lot of Wall Street seems to price off of that in some regard. What would that mean for mortgage lenders? Would they start doing loans at 0% or -%? And if you're doing loans at -%, how could you stay in business as a mortgage company?
So I think outside of, and we have to look to what we've seen in Europe, and outside of a few gimmicky promotions, we have not seen real yield or nominal yields for mortgages go negative in Europe. We've seen low rates, rates in the 1% area and stuff like that. So I think it would be a meaningful shift lower in rates, but I don't think that mortgage companies or mortgage lenders would be forced to start issuing mortgages at negative rates.
Yeah.
And I think also that I think it's fair to say that the prospect of negative yields here is pretty unlikely at this point. The success that we've seen in Europe has been pretty questionable, and it has some really serious impacts on the banking system, which, as you know, the Fed has done a lot of work in the last decade to repair and improve and strengthen the banking system. And so for them to kind of do an about face and take on an experimental policy framework that hasn't really been that effective in stimulating growth and demand, which is ultimately the goal, I think it would be a bridge too far.
Interesting. I mean, going down to, if it's a race towards the bottom, I guess, in interest rates, it makes me think of that 0% APR model, which clearly the finance companies have figured out a way to make money on that. But is that something that would really be good for our economy to move in that direction? And it sounds like you're saying you don't see a benefit.
People often describe it as pushing on a string. You can lower borrowing costs. You can only lower borrowing costs so far before a borrower really doesn't penalize to take on additional, debt and try and build something with that money. So as the cost of borrowing approaches zero, the additional stimulative, the additional demand that you're getting out of that monetary policy stimulus really just decreases. And that's what we're seeing in Europe, is that even with negative rates, you're not seeing this massive explosion of credit demand, which is what they're trying to get to, juice the economy over there. So I just don't think that we're going to head that direction. We're already at zero. That is our emergency level of monetary policy. And I just don't think we're going to go lower.
Yeah. And clearly the Fed, they mentioned that they're not seeing any increases until 2022. But, again, the permanent mortgage market is pretty sensitive to what's going on with the 10-year and does tend to move a little bit differently than those short-term rates. So, if we really start seeing an uptick in the 10-year yield, which you're not predicting at all, that would impact our rates. But sounds like you're seeing that kind of stay range bound through the end of the year. So good to know.
I think that's a pretty reasonable expectation. The Fed has said that they are going to let inflation run hot. So typically the Federal Reserve responds to rises in inflation by raising interest rates. And the Fed has said that they are actually going to allow above target inflation for some amount of time. And so if they're not raising rates over the medium term, even if inflation is running hot, that makes it difficult for the 10-year yield to really break out.
Right. Yeah, makes sense. Well, thank you. I mean, that is, I really do feel like I've learned a lot speaking with you about that
My
today.
pleasure.
Appreciate that. So jumping on into just kind of other things you're seeing in the market or things that are working for institutional buyers. You and I connected a while back in September, and the CD rates back then were, 150 or something. So clearly a big shift in the market. Where are the sweet spots, or what are you seeing, as opportunities in the market that we're in today for institutional, savers and investors?
Sure. So, the cycle that we're in right now, that kind of, when we started the pandemic, really around the beginning of the year, we saw an incredible opportunity, in March and April for investors that were willing to take a little bit of risk and step in as markets, were extremely volatile. So the opportunity before was to take some credit risk, to step into some really high quality names like Disney, like ExxonMobil, that you could get pretty significant yield, pretty meaningful yield, if you were willing to step in and buy those bonds at that time. Now that ship has sailed. And so I like to say right now that actually you're really, I think, better off being a little bit defensive. And, in sports, we often say, you have to take what the defense gives you. And right now the curve is so flat, and the Fed is focused on keeping the curve so flat that investors aren't really getting paid a lot to extend out the maturity curve and then take on a bunch of additional duration. So right now, what I think the defense is giving you is short and medium term risk. That's where, provided it makes sense for your investment goals, that's where your money should be.
So when you say short and medium term, define which, what time frame generally for both of those?
So I would say 5 years and in is what I think about as sort of short to medium term. You can go a little bit longer and maybe 6, but I think that in 3 years, 4 years time, we are going to be looking at a different interest rate regime, and to be extending out the curve and focusing on 10, 20-year assets I don't think that's going to pay dividends for you down the stretch or down the line, because the curve is very flat and you're not getting paid a lot of additional yield to take on that additional duration.
Right, right. Like what's the 30-year at today? I think it's like a 150 or 155 or something like that.
Yeah, exactly.
Yeah, that makes sense. So you're seeing shorter term instruments. Well, I'm going to switch and talk a little bit about that, because some of the instruments, that I've seen in my career, and I know you've seen in yours too, were centered around LIBOR as an index. Have you seen any shifts in behavior since LIBOR is supposedly going away and being replaced by the SOFR? But I really haven't seen much change yet. Have you seen anything on the front lines?
We have not. The basic market consensus right now is that, and this makes sense if you think about it, there's such a critical mass, such a massive volume of instruments tied to LIBOR, that there is going to be, when we reach the time when we're going to make a transition, there's no other choice than to make it make sense for the transition from LIBOR to SOFR. So you're not going to have assets that were yielding one thing on one day and suddenly they switch to yielding something dramatically different. The transition from a yield perspective is going to be pretty seamless. So it's not something that investors are losing a lot of sleep over right now.
Oh, that's good. Yeah, that would be quite disruptive, especially if it's like a margin plus index type loan, which a lot of them are.
Exactly, and for no reason, right? These assets that are tied to LIBOR should be paying the same rough interest rate based on the new index that they're paying. Investors should be receiving roughly the same yield. So all parties are really incentivized to have it be pretty seamless.
So as far as interim financing goes, there's not really anything different that you would recommend or see in this time as far as index or anything?
I would not. I wouldn't really recommend speculating on going to SOFR and trying to figure out what the rate would be. Price your instruments like they are normally priced right now, and when the entire market converts, your instruments will be part of that conversion.
Right. Yeah, and one of the reasons I was thinking about this recently too is I was talking to another banker who had a client that was going to get a swap done, and historically a lot of the swaps, at least in the lending world, they do use LIBOR as part of that equation, as an index. And it just kind of got me thinking about, if you're doing a swap now and then it goes to SOFR, what does that look like? But
your spread will adjust. If SOFR is meaningfully different, what the likely outcome is your spread will adjust to make your actual end yield roughly the same. So if SOFR is 25 basis points different than the LIBOR that you were using, then your spread is going to be 25 basis points in whichever way it makes sense.
That makes sense. Yeah, and that's a lot how the agencies price, actually, Fannie and Freddie. You tend to see them pull in spreads when the index goes up. Of course, times are kind of unprecedented now. Now we have floors, index floors, which we never had before. So going back to your day in and day out with institutional clients, what are you seeing as opportunities, or how are you advising in these markets? Are there ways for people to react to what's going on currently as an institutional investor?
Sure. One thing I like to really remind people, especially in times like this where it's things are volatile and investors have a lot of question about which ways markets are going, I like to remind people to really focus on what the actual investment objectives are for the funds that they're investing. Are they open-ended, or are these funds used for a specific project down the line? I work with a lot of institutional clients. Some of them have short-term working capital that they're investing in. That money needs to stay liquid, regardless of how low the rate might get. Tying that money up for a long amount of time is going to be ill-advised. And so investors really need to remember what the purpose of the funds they're investing is and not deviate from that, because it's just really easy to get in trouble when investors start chasing yield and forget about the purpose of their funds or their core goal as an investor and start just chasing the yieldiest investment possible.
Right, right. Have you seen some of that in the market where, the speed of these facilities is increasing, the convexity is increasing because people are trying to get out of one instrument and into another? Has that increased?
I think it really comes from frustration. I think you see people, you see the bottom fall out of short-term yields, and people start to get frustrated and start to ask themselves, well, how long can I tie up this money for really? How far out the curve can I go? What can I get if I do 5 years instead of 3 or 2?
Hmm.
If your funds are meant to be 2 to 3 year funds, and that's why it's really important to have a strong investment policy too. If you can look back at your investment policy and really remind yourself and take some of the emotion out of it, really remind yourself what your core goal is here, you're going to do a lot better in the long run.
Yeah, that's interesting. What do you think of just overall conditions in the market? You know, we've seen this sort of tale of two worlds, really, with the stock market, how it's had a lot of positive momentum. I mean, it's choppy, but it's had a lot of positive momentum going up, particularly the high.
Absolutely.
And then, you know, we've got these challenges where I don't know if we're really seeing or feeling the repercussions of some pretty significant layoffs or, you know, some things that have occurred in the economy. How do you reconcile those two together?
It's a really difficult economy to judge right now. I mean, we have not just the public health risks that can determine business outcomes, you know, for a large swath of businesses, but you also have, like you mentioned, you have significant layoffs and you know, creative destruction in a lot of different sectors at the moment. And it's really difficult to balance that against what we've seen to be extraordinary policy accommodation from both the Federal Reserve and the federal government. And,
Hmm.
you know, fiscal stimulus is often a very powerful tool. And the markets, that's really been the battle and the volatility that you've seen, is the markets trying to balance some really tangible and significant challenges with some really tangible and significant policy accommodation.
Yeah, I mean, you see, yeah, they debate all the time. You know, are things overpriced? Do these valuations make sense? You know, we were seeing a big uptick in value even before corporate earnings season. So that was one of the questions, and it just reminds me of a lot of the clients I work with in real estate as well. Even in a secondary market or, you know, close to a tertiary market, you're seeing properties trade in these very low cap rates, which are unusual, you know, for those types of assets, right? You'll see a 4 and a 4.5 cap where, you know, you might have been seeing a 6 before that. So I just wonder if this reaching for yield is kind of going on in a lot of different sectors.
I think it is, and I think it's all because, you know, the Federal Reserve drives the risk-free rate, right? That's what sets the rate for U.S. Treasuries and things of that nature. And so when the risk-free rate really declines, the appropriate spread for credit risk change, you know, that may change, that may not, depending on economic outcomes, but the absolute level of it will ratchet down. And so, yes, when you start to not be able to earn any money, really any significant interest for risk-free assets, people are going to drive down the real yield for risk assets. That's what you're seeing.
Oh, that's interesting. That's really cool. Very interesting. That makes a lot of sense, the way you described that. So, I mean, when will that discontinue? I mean, how does that cycle end, or does it end? Is it a gradual thing, or is it going to be a sudden sort of shift? What do you think?
Well, it really depends on two things, right? It depends on what the risk-free rate is and what investors' risk appetite is. Those are two different sides of the coin that will help determine what the appropriate premium for assets with credit risk and how risky those assets are. But as long as the risk-free rate appears like it's going to be low for a pretty significant amount of time, the only way that I see the chase for yield really, really ending is if investors' risk appetite changes. And that could be driven by the pandemic. That could be driven by increased layoffs and doubts about future corporate profitability and the ability to sustain earnings growth. You know, just normal economic concerns could decrease risk appetite as well. So that's another way that you could actually see a bit more healthy risk premium injected back into the market.
Interesting. Well, I think that's really, really good, useful information for all of our viewers. I know I learned a lot today. And is there anything else you want to share with us or add?
I think we've covered the bases. Thank you very much for having me. I really appreciate the opportunity to be on the show.
My pleasure. My pleasure. I hope you'll come back. Thank you so much, Winston.
Absolutely. Look forward to the next time. Thank you.
Thank you. Wow, that was a really, really informative episode with Winston. I think I'm going to need some new hats because I think my brain grew and my head grew just listening to him talk about the markets and interest rates. Got a better understanding for that today. I hope you do as well. Thank you all so much for tuning in to another exciting edition of Money Talks. I am your host, Michael Thomas, signing off.